Conflicting data, changing policies from DC to the Fed, all have left investors as confused as ever. This week, we're going to discuss the good, the bad, and the likely path forward. One of the things we've touched on in these commentaries time and time again, because it's so easy to slip into our subconscious that we need to keep front of mind, is the ever-present tug-of-war that's going on within all of us and even from the outside upon us between bullishness and bearishness, those impulses of fear and greed. It's probably particularly pronounced at a time when maybe bad data is good because it means the Fed will cut more. And is the Fed going to change direction? And now we've had an election year and we're going to have a change in policies within DC. All of this weighs on us investors. And the natural reaction, more times than not, is to do something. Sometimes action's called for. Many times, of course, staying the course is the appropriate path. But just doing something to do something, as good as it might feel in the moment, more times than not, if it's coming from that emotional place, it's going to take you in a bad direction. So this week, again, to help get us mentally prepared for all the things we may hear or we already may be reading, we're going to go over what are some of those positive catalysts, those truths that are there that could propel the economy and markets higher, or some of those potential stumbling blocks that we need to be mindful of. And of course, is there anything out there that might put us on that risk-adjusted basis on more assured footing? A lot of data we're going to get through, a lot of charts. All of this is in the written commentary this week as well. Probably one of the biggest things as we look forward is just, is there anything to propel markets higher? And what propels markets higher is cash. More people with money to go buy whatever they're going to buy, stocks, bonds, real estate, etc. One of the things we have right now is that there's about $3.5 trillion in Treasury direct accounts, consumers going to the treasuries, and $6.5 trillion in money markets. So almost $10 trillion of cash on the sideline. Now, some of it's always going to stay in cash. I think sometimes those kinds of data points are shared with the idea that it's all going to come rushing in to market. Some of that's money that's there to be safe for a long time. But there's no doubt with interest rates coming down from where they were previously, a lot of that money's going to be looking for a home. This is a point that Torsten Slok pointed out is likely benefiting stocks, higher yielding fixed income, potentially other alternatives as well. A second key data point is just the health of the U.S. consumer and corporation. Usually when the Fed raises rates, that really slows the economy down, puts a crimp on consumers, corporations, et cetera. Because rates had stayed so low for so long, what we're seeing is consumers, certainly a lot of corporations were wise, locked in their rates. And now, if you look at the data points, you see that whether it's net interest payments as a percentage of operating revenue for corporations or just debt to income ratio, they're both extremely low, meaning there's just free cash flow, whether that's to support investment for corporations or investors, or whether it's just to support purchasing of items within the economy to propel economic growth. That is a definite solid, particularly in a consumption-based economy. Now for the bad, or at least the less good. As we wrote about on October 18th, talked about in last week's video, or the video from a couple weeks ago on November 22nd, market valuations are stretched. And if you go back to that chart in October 18th, you'll see the price you pay for things matters. When you're paying high 20s, 30 times earnings, in some cases we'll see 50 times earnings for something, the prospects of that being a winning investment over the next 10 years are extremely low. I think the question people have, or the narrative that bulls will offer is, well, hey, earnings are going to go up. That's true, although historically, more times than not, price reverts down to a more fair valuation. As Torsten Slok, chief economist at Apollo, put this week, one way to analyze if stocks are cheap or expensive is to remove the business cycle by taking a 10-year average of earnings. And if you do that, the cyclically adjusted price to earnings ratio is 38 times earnings versus a long-term average of 17 times. So definitely expensive. More than that, if you look at the top 10 names that make up the bulk of the S&P 500 now, their earnings, the movement within the general indices, those are trading near 50 times earnings. And as he questions, would you buy a stock with in a firm with a PE of 50? And the answer, I think, for most investors would be no. And yet, for people blindly piling into broad-based ETFs or the stocks that are making news in the newspaper, that's exactly what they're doing. A second troubling, although this is more quantitative than fundamental when it comes to analysis, data point is consumer sentiment, which is extremely bullish right now. As the Conference Board, which does a survey data of investors, looked, a record all-time in modern market history, going back to at least 1987, of 51.4% of households are bullish on the market. That's higher than before the crash in 87, 2000, some of the early peaks in the build-up to 07, 2020, et cetera. Doesn't mean the market's going to crash, but again, if we think about that sloshing we've talked about within markets, when everyone gets on one side of the boat, it's really hard, again, to understand where some of those catalysts higher might come from. So with all this tug of war between the good and the bad, where do we go forward? We've talked about this a few times, beginning back in May. Turned out to be, for many alternative assets, perhaps a near-term bottom. Look to things beyond what the crowd is fixated on, namely the private sector. It may not be appropriate for everyone or in the same manners, of course, but if you look to private markets, I think historically people think of them as more risky than public. We would challenge that paradigm, and a lot of our partners, again, are challenging that paradigm, particularly when one thinks about, hey, a great way to better diversify myself, protect myself, or even look for opportunities is to have the broadest set of potential things to invest in possible. Doesn't mean you abandon public investments, but with 86% of stable firms, these revenues of over 100 million, are private. And so again, there's just a huge subset of opportunity that should at least be looked at, whether that's in the credit space, the private equity space, or the private real estate space. Even if one doesn't want to go into private, this next chart that Matt will put up is from Goldman Sachs. It shows it look beyond these top 10 stocks that are dominating everything. They've dominated growth, they've dominated earnings. As this chart shows, Goldman Sachs, and many think that's going to shift to what we'll call the other 493 stocks within the market. So there's a broad subset, again, of those stocks that have been left behind, those companies that have been left behind, that not only will participate just because, but literally will likely see increased earnings in the years ahead. In closing, one of the most dangerous things, the cliche goes in investing, is to say this time it's different. And for those out there saying, hey, this time will be different, this rally, this narrow market, this particular stock trading at a certain multiple, it's going to work out differently this time. It can, but it's a dangerous ground to stand on. We, again, would argue price does matter, opportunity set matters, and the good news is, as much as has been the case in a very long time, there are a lot of interesting things to go take a look at. If you need help with this anytime or want to understand how we're putting it into practice here at 10 Capital, please reach out.